Check, 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 check. Uh, let's try this. Hmm. Get my notes here. Come on. There. Wow, this is nerve-wracking. All right, good evening. Welcome to the stream. This is how we're going to get to our weekly bias. Um, and well, I guess I introduced it out of order. Um, so this is going to be a top-down analysis of really the commodities markets. And by commodities markets, I mean instruments traded on the CME. So like futures, we're not really going to be going over currencies, but we are going to be going over the Dixie, but also um, real commodities, the actual, um, the goods, the metals, all those things. Also equities and treasury bonds. Um, is that all of it? Let me see. That's about all of it. We can even talk about Forex a little bit. Should I talk about Forex? We can talk about crypto. Yeah, we'll talk about crypto, but just in a general sense, like the bitcoins, like Bitcoin, obviously, and Solana, and well, as much as I as much as I like Monero, not so much Monero, but Ethereum. Ethereum. So Bitcoin, Solana, and Ethereum are the ones that we're going to talk about. So the elephant in the room. What am I doing on a 3 month chart? Who in the world needs a 3 month chart? Well, my humble opinion is that everyone does. Why? What are we doing on this chart? We are tracking the macroeconomic trends. Okay? That's the first, well, that's the very first thing that I want us to do. And the reason that we're doing that is because we want to see, well, we want to see where everything's going, right? So here is where we're going to start. We're going to start with the bonds, and we're actually going to compare every asset class except for the cryptocurrencies to these bonds. Okay. First up, we have the Dixie. So you guys probably know that intraday and on a short, intermediate, and long term, the Dixie and the bonds, they have an inverse relationship. And when I talk about bonds, I mean the bond futures. That's these T notes, right? Um, Now, what we're really doing when we're checking the bonds and measuring the bonds is we're looking at the yield of these bonds. So when I go and I look and I check here, we see that we have a perfect reflection of this chart right here. So the correct way to do it is to use these futures contracts. Why? I actually don't know why this is a better way to do it, but we're going to do it this way because uh, that's the way I was taught. That's the way I learned it. So what's the relationship between these futures and the dollar index on this macro scale? Well, when we see the T notes going up, the Dixie goes up. when we see the T notes going down, the Dixie goes down. Make sense? Obviously, during intraday, well, we're gonna get to the intraday and the what's that word, the short, intermediate, and long term relationships between these, and we're gonna see that they're inverted um, on those lower order scales. But on this large, big, grand scheme of things, um, these T notes, these treasury notes, they basically represent the value of the dollar. The dollar is a debt-backed currency, and whatever the treasury bonds are doing, um, well, I should probably say first, the treasury bonds, they provide the backing for the U.S. dollar. They are the actual value. Let me say that again. They are the actual value of the U.S. dollar. So as the treasury bonds are going down, obviously the dollar is going to go down because this is actually the dollar going down, but in an asset that people aren't paying as much attention to. So um, this is more of a true read of what the dollar is doing. Ultimately, at the end of the day, the dollar is going to pay the piper. It's going to drop, and yeah, that's going to be what we're going to see. Um, so all of this upward movement, we're going to see when we look down on the lower time frames that it's fake. And what do I mean by it's fake? Well, obviously it's real. It's in the charts. If you weren't in it, if you were in it, you probably got chopped up, or maybe you bought it. Maybe you did. Maybe you traded it brilliantly. So it's real in that sense. But we're gonna see that all of this movement was very limited to the upside. It was very turbulent. It had some trouble because we had this, right? If you didn't see this on the scale, you wouldn't see this. You wouldn't see that the dollar is gonna drop, right? And really, when did the dollar start dropping? Well, mm, it's not time for that yet, not quite yet. So let's get on to the commodities, and then I'll talk about why the dollar did this, because the whole um, the whole thing is about lead and lag times, and we're gonna bring that together very nicely. So next we have the Thomson Reuters Commodity Index. What is the relationship between commodities and treasury notes on the long term? It is while the treasury notes are going down, the commodities are going up. Okay. So now this is a very simplified idea. Uh, I don't really want to go into the economics. I don't feel like it. I don't have the energy to go into it, and I think it'll just confuse people at this point. But for right now, just know that the rule of thumb, quote unquote, as in 90+% of the time, as the treasury bonds are going in one direction, the commodities are going to oppose it. Okay. Now there is a caveat to this particular index, because this index is heavily weighted by agricultural things. So like wheat, lean hogs, cattle, all that stuff. It's in this index. It's heavily weighted by this index. So what does that mean? Why did I bring this up? Well, right now um, those agricultural things, they're artificially inflated. They're held at a higher price than they should be. So this index is not going to reflect the actual pressures right now. It's going to reflect those inflated prices, those extra, um, what's that word? Well, they're going to reflect higher prices than they normally would. Now, I don't think that's going to be a huge problem. For rigor's sake, we have to say that this isn't correct. that this is not showing something that's indicating what the actual capability, what the actual economic capabilities are able to do. It's just an artificial supply and demand controls. So, although this is still good, this is still good to read. This is perfectly fine for our purposes. We have to note that this is artificially not what it's supposed to be. All right, so how can we check our work? How can we look and see the rest of the commodities? Well, we can come over here. We can go to the Goldman Sachs Commodity Index. Now, what about this one? This particular index, um, it's heavily weighted by metals and energy. So metals and energy, they're still seeing a little bit of man, most of the time I'm stuttering. Now I'm trying to figure out how to say this without getting banned. Wow. They're still experiencing the okay. So metals and energy, they're not experiencing the same problems as much as the grains in the agricultural sector are. So we're gonna see a little bit truer of a read in this market than we would in the other one. Okay. So notice how it comes down a little bit more and is doing its little consolidation. If we actually look at the Dixie, we see that it matches, right? So we see that this little manipulation is actually reflected in the real commodities market. Whereas if we look at the fake one right now, we see that it's a little bit lighter. It's a little bit flightier. It doesn't want to dig down nearly as much, right? So this manipulated commodities market is actually show, it's actually showing it's actually calling the bluff that Dixie is putting out, whereas the real commodities market is not. It's still held. Um, I don't know. It's held, man. It's held. So now equities. So what's the relationship between treasury bonds and equities? Um, as treasury bonds go lower, equities go lower as well. What do we see happening here? The opposite, right? So this price structure here that we're actually seeing in the S&P, um, this is what a lot of people are thinking about, and they're seeing and they're calling bull markets, and they're saying that, oh, it's going to be going up here. It's going to be like let's let's do their projection. It's going to be going to, man. It's hold up. I know, streaming thing. It's going to be going to 6,000. It's not going to be. It's not going to 6,000, right? So why? Why would I trust the bonds driving price down over the equities pulling price up? Well, it's because the equities are not going to win. Where does that come from? Where does that idea come from? Well, the bonds are the very heart of the market. The bonds are the very heart of the value of the dollar, whereas the equities are just some companies, which are honestly not very good. Like, have you seen? No, I don't want to get banned off YouTube. Hmm. If you've seen certain business practices from certain large companies, they just don't make sense. And if you do the math for their pricing structures and everything, they're not made to make money. They just don't make money. right? Um, so that this is not real. Basically, is what I'm saying. Um, but this is going to drag equities down just by the mechanic of this long-term trending. Um, the declining in the value of the dollar is going to drag the U.S. market with it. So that's that's something to watch out for. That's something that's going to happen in the near future. No, we're going to discuss that. And if we look at Nasdaq, obviously same thing happening. We see it bluffing out the treasury bonds. Um, Now, if you bluff the treasury bonds, if you play chicken with the treasuries, you're going to lose. So these are going to lose. Obviously, they're going to drop down. If we look at Dow as well, so far we've looked at 500 companies, 100 companies. Now we're looking at 30 companies. And in fact, these are the particular companies that are in the Dow, they're more like industry companies. Whereas the S&P and the Nasdaq, they're more weighted with tech companies. So the Dow is going to give us a little bit more of a, I guess, a on the ground look at what the equities are doing, because eyes are not really on companies that are not in the S&P or in the Nasdaq. Um, Once again, I don't want to get banned, so I won't name names. But the Dow, we can see that it's a lot heavier than the S&P and the Nasdaq. What about the Russell? A lot of people don't think. Well, a lot of people don't look at the Russell. They don't consider it. I usually don't consider it except for intraday, day to day. I don't consider the Russell. But for these macro trends, take a look. Look at that. So the Russell 2000 is betraying the pressures that are on the equities. How about that? Beautiful, right? Well, not so beautiful. It's technically beautiful, but probably a little bit scary for some people. All right. So now what's the next thing I want to look at? Well, first I want to do a top-down rundown just to make sure that you guys understood what was going on. So first I look at what the treasury bonds are doing. What's our macroeconomic trend? It's going down, right? Then I'm going to look at the dollar. I'm going to expect that to follow. Okay. I'm going to look at its price structure and see if there's anywhere that maybe it's going to want to kind of ignore what's going on for a little bit. So now, why would the dollar ignore the treasury bonds? It can ignore them for a little bit. It can actually ignore them for some time. It can ignore them for up to, look at how long it did it. 1, 2, 3, 4, 5. 5 solid quarters of up candles while the treasury bonds were dropping straight down. How long is that? That's longer than a year, right? So basically, using these trends, we would have looked for the dollar to start to try to turn around, and we really wouldn't have touched it or done any kind of analysis or anything with it until we saw that turnaround, because we want to see we want the macroeconomics to be right. We want them to be in touch with what's going on with the markets. Once again, well, actually, these are better, and these again, they're a little bit. These sucked as well. Um, Also, remember the time period that this was in. I won't name it because I want to stay on YouTube, but the time period that this happened probably played a role in that run up. But yeah, so that brings me to the other point. Notice how it took such a long time for the Dixie to get in line with what the Treasury bonds were doing. That is because with these big macroeconomic trends, it takes a while. It takes a while. Usually, we're going to see the Treasury bonds leading. Sometimes, every once in a while, we're going to see the commodities leading. In fact, we did see the commodities leading here. Did we see it anywhere else? No, Treasuries led that one. Did they? Hmm. Treasuries led that one. Okay. Treasuries led this one. But yeah, so the least amount of lag time that we're going to see is between our T notes and our commodities. Okay? So seeing this chop while this is digging down, that's very interesting. Um, that doesn't really show a crossroads because we're going to have to see it here and this one on the left. But what it does show is that we're kind of that we're kind of held up, you know? Uh, what else was I going to say? I think I had something else. That's all right. That's enough for right now. So now we're going to go down to. Come on. Come on. Come on. So we have Dixie and T notes. Perfect. 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 So now we're going to do something else. We're going to start. Come on. All right. There we are. Perfect. Perfect. All right. So we're going to go down to the weekly. And what we're going to be doing on the weekly is we're going to be analyzing um, we're going to be analyzing with these seasonals to try to find the highs and the lows in this chart and where maybe they can potentially form in the future. I think they've already formed right now, but at least this low right here in November. So why am I going into seasonal tendencies? Well, what these seasonal tendencies are and what these seasonal tendencies do is they kind of show the the what's the word? They show the investment priorities of very large institutions and banks and all that stuff, and the central bank themselves. So, so that's why we're checking the seasonals. Basically, um, this shows when highs and lows in the markets are printed, and well, yeah, it shows when highs and lows in the markets are printed, and it shows where um, wow, I'm having a lot of brain force today. So it shows highs and lows in the markets where the what's that word? Has something to do with institutions. Where institutional traders change their investment priorities. That's it. All right. So these highs and lows in the markets where these institutional traders are changing their investment priorities, we see them. They basically happen like clockwork, and the reason that we know is because these charts, which are both aggregates of periods of time. One of these is 10 years and one of these is 70. I'm sorry, should be 70 years of data. Um, it's not. I'm going to tell you right now, it's not 70 years of data. I think it's more like, well, it's as far as back as the futures contract goes. So one of them is the maximum data, and the other one is 10 years. So together, where the highs and lows match up, um, that's going to be where our highs and lows. That's going to be where we expect the highs and lows to show up in the marketplace, right? So when we look at November, this is November. See January, February, March, April, May, June, and so on. November. We see that early, well, not right away, but early in November, a low forms and we get a pop up. Interesting. So this whole time, the market trades down. Market tends to trade down, and then we get a pop up through November, right? Let's see what we see. We also have we have another one in October. We have another opportunity, man, late October, basically the very end, beginning of November. So we see both of those lows. Let's go down to a daily chart. I was using the weekly because it's very clear to see, but it's also very important to see the qualities of these lows. So it's really a big deal. So why am I looking at lows? Why am I not looking at highs? We can. We can. Like, for example, let's look at this one. Very beginning of October. There it is. Then we have, which day is this? 12th of October. Right here. There it is. So yeah, well, basically it works. It what was I gonna say about it? That it works. That was what I was gonna say about it. So here we have our low of this structure. Let me do this. Okay. 13th of November. 6th. 13th. That kind of looks like a 13th kind of thing, huh? Doesn't it? Is it? Maybe that should have happened last week. Like more around the 8th or the 10th. That would have been. That's all right. That's fine. That can be there. But basically, what this is telling me is this is telling me when we're gonna see particular lows and when we're gonna see particular behaviors in the marketplace. So October 19th. Let's go ahead and study this a little bit. Does that make sense? Well, that this is October 19th. Does that make sense? Yeah, it does. Because look at here, this little microstructure compares to this larger structure. Whereas here, this low right here just kind of happens. This one has a reason up here. And then we have that. And then we have that. so that kind of corresponds to some kind of a bullish scenario, right? A little bit. Okay. Then what about this one? October 4th. Did we have anything? No, doesn't seem to be significant. It's really this one and really this one. But between mid October, early November, we have these significant lows. All right, so that looks fine. That checks out. So why am I doing this? Why am I looking at this? What does this actually do for me? Well, this tells me which way to bet. If I see these significant lows, and if these significant lows form, then it's done, right? It's done. I can, um, what's the word? Man, I don't want to swear either because I know how that YouTube hates that stuff. This would be so much easier if I could. So, hmm. So yeah, basically it tells you which way to bet. So if you get these lows, these very significant lows, you see that seasonally they're very significant. So it's very high likelihood that you're going to have institutional sponsorship behind it, and it's going to form some kind of a meaningful bounce at the very least. Usually a very dramatic movement. It looks like higher. Um, and as we analyze the charts, we're going to go ahead and give that some analysis. Um, this right here, just looking at this charts, I can see that we broke our structure and we made this low right here in line with the seasonality. This one right here. Ooh, excuse me. And that's basically just going to slingshot off for the, is that short term or an intermediate term? That is the intermediate term that is going to slingshot off for. It's probably going to go into December, a little bit higher. But that's for later. We're going to come back to that when we actually start analyzing the price structure. Ugh. So then we're going to go ahead and check all of these, every single one. Excuse me. Sorry about that. All right, so early November high. We also have an October high. Do we? Yes, we do. Then another one right there. One at the very end of October. No, this one's very important. Right here. Boom. Okay. So all of these, basically I'm not looking at these for, I'm looking at these for two reasons. One of them, one of these reasons that I'm looking at this is to see that, yes, a high can form here. And then a high does form there, right? Where is this? 3rd of October? Yep. Right there. This is this high. So the second reason that I'm looking at this, is because I want to see how do these highs form in relation to how they normally form. Okay, so notice the 3rd of October high is the highest high in all of these. So my first confluence that I'm going to expect lower prices during this, I guess this next quarter, is that normally we see a higher high here, but we don't see a higher high over here. Yeah, very end of October, we don't see a higher high here. So this correlation is so strong that every single year, like clockwork, just on the dot, it forms a higher high in October, but this October it did not. Does that make sense? So now does it make sense why we were watching the macro analysis? Because why would we be looking for reasons for it to go lower? Um, and why would we view this as a reason to go lower? We could just view this as, oh, it's just printed a lower high this time. You know, that's something that we could do. We could also view this as it's just kind of what the chart does. We could view this as, oh, it's random chance and it just so happened to be lower. We could view this as some kind of a retracement from the uptrend where it's going to continue uptrending. But really, ultimately, the decision that we came to on the 3-month, right, on the quarterly chart, was that we should be declining sooner or later. We should eventually start declining. Our upside potential should be limited. It should not be able to push very high. Or rather, it should not. Yeah, our upside potential should be limited. So that's why we're viewing this as such. And also take a look. When we look at this large scale, the big one, the big line, what do you notice? I'll tell you what I notice. For most of the year, this is downtrending. Right? Does that make sense? That this is downtrending? Now look at the quarterly chart. Hold on. If we can get that to fit. All right, so let's look at the quarterly chart. What do you notice about this chart as opposed to this chart? The green line. What do you notice? This line, this one in particular makes this, right? So in order to go higher for the middle portion of the year, Dixie declines. It drops down. So what does that mean? What does that mean for us? Well, let's go back to the daily. Actually, let's go up to the weekly. This is what the weekly is good for. August, September, October. Okay. So man, this doesn't really illustrate my point all that well. August, September. This doesn't illustrate. This does not illustrate my point for obvious reasons. There we go. Nicer chart. Nicer chart. Yeah, 2019 was still pretty bad year. It sucked a lot. To December. August. November, December. Alright, so maybe it might go up. Might do that. And then it'll do this. Dang, there's no good examples. This is really the best example that there is. That's crazy. Are there any examples before 2008? Let's see. But yeah, this is basically the thing that I'm interested in. So I wanted to roll over in October. Ultimately, at the end of the day, let's go back. Wow, looking at those trends, it really doesn't have to. It's making me second guess myself. Uh, it's all right. I know what I'm doing. So, uh, so yeah, seeing those these highs print this way, when we should be getting a higher high, that's our first sign that we might be looking at a reversal. Okay, and that's really the bonds. They also kind of agree with that. Let's take a look. So this is ZB. Is that ZB? No, this is ZN. It's November, October. Okay. So October, see that October likes to drive lower and form lower lows. Let's see what it did. No, higher lows. Kind of the start of the October. And then it drove down. Okay. Which is fine. That's what it's supposed to do. But then, no, then it actually makes higher lows. No, I stand corrected. Which one was it? Probably ZB, huh? See, I know all the bonds are the same right now. Yeah, it's ZB. Okay. So ZB, we see that it likes to drive lower lows. But here, we see that it's not doing that. Right? See that? This is a type of divergence. Okay. So that's our first sign that we have a crack in our correlations. As ICT would say, God rest his soul. Um, what else was I looking at? What else were we gonna do? I know I feel very unprepared. This is my first time doing this, and I'm not a very personable guy, so it's a little bit difficult for me right now. I'll get better. Do Yeah. So let's talk about indices. If we go into our indices, well, I actually want to talk about bonds as well, but we'll talk about bonds last. Yeah, we need the continuous, continuous, continuous. All right. So the continuous contact of the indices. Ugh. It shows us something very interesting. Do, do. There we are. That should be fine. All right. So looking at this chart for October through November. Let's zoom that out. Looking at this chart from October through November, we see that the very beginning of October, if we can find it. Yeah, here it is, the very beginning of October. We have our low. And this is seasonally the lowest low, whereas here we drove lower. We came up. So that could be very bearish, potentially. That could also be bullish. Why? Why could that be bullish? Because in the S&P, we have some room to move up. This high right here, or at least I believe this high, should be, you know what, we'll save that. We'll save that. Okay. We'll go on the daily. We'll look on the daily. We're going to see that through November, we trade up. Okay. Pretty good, right? It can just trade up. Is that agreed that it can just trade up? Yeah, I think it can just trade up. Possible highs, they can come right here. This one. They can come right here, right here, right here. Which can be this week. They can come right here, which can be next week. And they can come right here, which could be the very end of November, which is that Thanksgiving week. Now, during the Thanksgiving week, I don't expect it to. How should I put this? No, let's not talk about the holiday expectations right now. It may be a turning point. It may be just some point where it wants to sit and consolidate for a little while. Um, I don't know. I don't know what the holiday's gonna do. But for now, I look at this, I see what it's done, and I see a bullish seasonal. Should be fine. It should be bullish. Um, Now, why would I call this higher? Why am I saying that this is bullish when what's the word? When our macro perspective tells us that we're bearish. This is when we need to zoom out a little bit. We need the monthly chart for this, actually. Not this one. No, you stay on the daily. Because that's what this is calibrated for, the daily. So we go the monthly chart for this. We can see that we have our high, our low, and our lower high. Now, if we push up, and even if we violate this high, even if we do whatever whatever we want to do, anything, if we're wildly, insanely bullish through November, and we break this high, we do all of the crazy stuff that we ever wanted to do. What would that actually do for this price structure? Will that change it? Will that make it bearish then? My answer is no. I don't think that there's anything reasonable that this could that a bullish prognostication can do to change this chart, because right now it's very very bearish, and it's a very big deal. It's a very bearish chart. So let's look at the Nasdaq. Okay, okay, okay. So with the Nasdaq, it has a very similar seasonal to the S&P, and that's just because it's all the same companies. It's all the same everything. So we're gonna have that low in October. It's a little bit more. It's a little bit lighter. We should say. So it's not going to decline. Should I say it's not going to decline? No, no, because neither of them are going to decline. But the Nasdaq is going to be a little bit more responsive, because that's just its quirk. Again, if we look at the monthly chart, we see high, low, lower, high. If we punch through this, if we do anything like insane, absolute nutty tricks, whatever, is that going to change anything? No. And in fact, I don't think that it's going to punch out this high right here. I think it'll get very close, but I think it's more or less. I think this high is safe. We'll go over why and when we start studying the actual structure of this price. But for now, basically it can be very bullish. It looks bullish by the seasonals. I see no reason to contradict it. I see no reason in price to contradict it from here. So yeah, there's no reason for it to be contradicted. Let's go to the Dow. Take a look at the Dow. Contains my trades. Let's take those off for now, just because it's hard to read. Off. Fly. Okay. All right. We can look at those later. We can look at those in the next one. Actually, we shouldn't look at those right now. So when we look at the Dow, we see that at the very end of November, well, we actually see that we do uptrend, but it's much more turbulent through November. Okay. Mid-November, actually a little bit after mid-November, we're gonna have a low probably. Here we can have some nice lows. We can have a nice high. We can have a nice high. Dow can actually be very bearish if it wants to. So this seems to be one of those times that Dow would be predisposed to drop. But as we can see, it follows that same price. It follows that same price structure that the other ones had. October, nothing very strong, except for this one. This is the only strong low. This low is kind of okay. Very beginning of October. Yeah, it kind of screwed that one up. And yeah, it really didn't want to follow its seasonals through October. So Dow's been kind of loosey-goosey, so I wouldn't trust it with much of anything. We can't really do anything very precise with it. Now, why do I want seasonals behind precision? Or actually, why would I say that? The reason is because when we have these seasonals in play, when we have these seasonals in place, that's kind of a known factor of how smart money and how the institutions are moving around funds. When they're moving around funds, um, that actually does two things. That creates a lot of volatility, that can create a lot of choppiness, but most importantly, that can create very strong, powerful levels that you can read price from. And it's just very, very nice. We don't really have that in Dow. We have that in, I believe we have that in the S&P. Yeah, we have it kind of, it's kind of there in the S&P. Is it? It's okay. See, this low right here, this was seasonal. Boom, right there. So we know that there's smart money in here. We're not really sure where they're we are not really sure what they're doing. We're gonna want to analyze this further to really understand that. But we know that there is smart money in here. They're working. How do we know that? Because they printed their seasonal low. Um, let's see what else. I don't think that you guys are interested in. Pa, 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 pa. Should we go over intermarket yet? Yeah, we can go over some intermarket analysis. So at some of these seasonal levels, one thing that we can do is we can do what hmm. So one thing that we could do is we can analyze these highs and lows that we get in the marketplace on a seasonal basis, and we can see across asset classes. Well, we can see across assets that are very closely correlated if if they want to show a crack, if they want to violate what's going on, right? If they want to change character. So right here, what we're doing is we're looking at the S&P and we're looking at Nasdaq. These ones are obviously very closely correlated. They're mostly the same companies. Um, it's mostly the same drivers, same everything that moves them. So any cracks between them is going to be very significant. I don't see any, obviously, because we have a low and a lower low. Here we have a low and a lower low. They're both fairly obvious. So those don't really illuminate a whole lot. What if we go to do we want Dixie or do we want bonds? Right. So what if we go to some bonds? We start analyzing some bonds. Well, if we look at this high in Dixie, hold up. Let's switch over. Dixie can be here. Bonds can be here. So if we look at this high in Dixie and then this lower high, what we're going to want to see in these bonds is that it's going to print a low and a lower low. Why? Now, why, why on earth would we want our bonds to print opposite to Dixie? Well, let's take a look. Remember what I said about that green line in Dixie? Well, this green line, the bonds, is going up, right? So for these bonds to print the same trend that we see in Dixie, it actually opposes through the short, intermediate, and long term. See that? So these are gonna kind of like step ladder each other. They're going to like ratchet each other. They're gonna seesaw. They're gonna teeter totter. They're gonna do all that stuff. Um, so if we look, that's also proof that proof. No, I don't have proof of anything in these, or at least I'm not bringing any. I'm not showing it because I'm gonna get banned. So what I want to see in these T bonds when I see this high and this lower high is I want to see a low and a lower low. Why? Because as you can see, they oppose each other, right? So what's the correlation going to be if we do a high and a lower high in the bonds? It's going to be a low and then it's going to be a higher low, right? Because this is transitioning into an uptrend as this one's transitioning into a downtrend. So that's what we should logically see, right? But instead, what we see is we see this low and we see this lower low. Now, how can we know that that's really what we're seeing? We're not going to know for sure. Um, and there's some I don't want to bring in the macroeconomics in. I don't want to bring all of the real complicated stuff in. This is already a lot to chew on, and I'm not presenting it very well. So uh, so yeah, this is all we're gonna do right now. Basically, what I want to see that low, lower low, in one of these, either no, this is ZB. So we're gonna use the 10-year. Ideally, in one of these, we want to see a low and then a higher low. We didn't get that. But we did get another kind of divergence. That was very good. We'll go over that in a second. Let's go to ZB. I think it was in ZB. So it's October low, November lower low. Yeah, so this is the lower low that it printed. So this is a different type of divergence. So we see how it prints a low right here and a higher low. What does it do seasonally? Low or a low anytime in here, lower low. And then see when it's strong, when it's very, very strong, it prints a higher low. But see how far removed this higher low is from this lower low. Isn't that crazy? Look at this one though. The one that printed the higher low. See the difference? So on average, this just kind of drifts up and consolidates, but it displaced. So that's a kind of divergence too. That's another thing to see in a way. So I just kind of in my head, as I was doing this by myself, uh, last night and two nights ago, I just kind of did that for myself. I apologize because right now my train of thought is very scattered. I'm not very good at speaking these things out loud. So just bear with me. Keep in mind that I'm gonna get better as time goes on. Let's see what else. What else are we trying to look at? Do So we called the indices higher. We called the bonds higher. We called Dixie lower. Okay. What are we missing? Ah, commodities. Okay. Higher. Commodities higher. Why? Um, well, it's true that they're being held and that they're being artificially pumped and they're being manipulated in all sorts of crazy ways right now. Um, I still believe that commodities are going to go higher. They may not be super dramatic. It might not be like a vertical parabolic run up, but if I can find them, they're in here somewhere. If we look at like gold, let's look at gold. Come here. First of all, treasuries down, gold up. That's very important. That's the thing. Second of all, on the short, intermediate, long term, not the macro, the short, intermediate, long. Um, Dixie down, gold up. Third, what I want to show you. Let's go on the weekly. See in October, the market trades down, 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 down all year, and then pops in October. Then trades down, down. Where? Where are you? Where are you? Where are you? Down, 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 down. Pops in October. Down, down, down. Where are you? Down, 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 down. It's November, December. This one was an actual bear market, so that's a little bit different. Um, but see, it had some events driving it, but down, 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 down. Where are you? November. Yeah, this one was held until January. Here we have down, 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 down. October runs. Where's October? Down, 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 down. October pops, and then we do this little number. Basically, what I'm getting at is that October is seasonally the in a bull market as prices being suppressed, as prices forming its little bull flag. Um, at that third quarter, that fourth quarter, um, I'm sorry, at the start of that fourth quarter every year, it pops. It likes to form these bull markets. So when you look at these seasonals, um, you're gonna notice something. You're gonna notice that they're kind of flat. They're kind of odd to look at. Because see how it's driving down, but we're wildly bullish on. Ugh. We're wildly bullish on gold long term. Why? Just look at just look at the overall trend. It's just bullish, right? But we're driving down through these seasonals, right? So that's another one of those things that you just gotta be aware of, that you gotta look out for. Mm, yeah, here it is, October. No, that's a 1 week daily. There we are. There we are. That's much better, isn't it? Okay. So it still doesn't reflect that during bull markets, there's just this crazy drive up, right? So with some of these, especially these event-driven markets and these markets that choose their direction based on their condition, you're gonna see these kind of odd. Well, basically, you're gonna see these shorter term trends, but in the long term, they're gonna kind of even out. So in October, we have the low basically right here, and then it just kind of either it picks a direction. It either drives up or it drives down. If it's going to drive down, it can print a high here. It can print a high here. But basically, it picks a direction. Now, which direction do I expect it to pick? I expect it to go higher, right? Um, so what's the basis of it going higher? Well, like I said, Dixie is declining. Dixie has shown evidence that it wants to decline. So gold should run higher. Now, I don't think that gold is going to go on some crazy bull market. I think that it's going to be kind of muted and kind of really frustrating price action. Why? Why do I think that? Because the BRICS currency, which is supposed to be gold backed, has not come out yet. And we still have the US dollar as the reserve currency. It's on its last legs, but we still have that. Um, so while that's there, everything's just kind of holding on, doing who knows what. So, what else? What else do we want to see? Ooh. Well, at the very end, I'm going to do a rundown. We're gonna basically go over some notes of what I thought about the very top to the very bottom and what it means, and we're gonna do our technical analysis of these actual charts themselves. And that will be it. So Bitcoin. Yeah. Bitcoin. Let's go to our reduce our period on that. There we go. Because we have to have a fast and a slow. This is our fast period. This is our slow period, and we're checking highs and lows based on them. So Bitcoin, it's not super established. Its highs and lows are not put in the marketplace all that strongly. Let's check it out. So this one is the most. This one is the most subject to change out of all of them, basically. Now, there's something special I want to say about Bitcoin. It is another one, just like gold, that decides the direction of its trend based on whether it's uptrending or downtrending. This could be true. It could drive down through November. But also something that it can do is it can drive up through November and December. Let's see if we can find an example. No, that was the transition. July, August, September. Okay. Ugh. So see how it just drives up and up and up and up, and then it does this retrace and drives up and up and up? That is the actual seasonal for Bitcoin, if it's bullish. And if it's bearish, check this out. Doop-a-doop-a-doo. May, awesome, very cool. September, November. Okay, see that? Downtrend. So we can see either a high or a low in November, one or the other. Does that make sense? So if we don't see a low, um, no, actually we're trying to see a low. Okay. And then from this, probably this low right here, we're gonna rock it off. If we're bullish, if we're bearish, we're gonna see it kind of pull up and maybe do some cool stuff up here. Um, it might wick above. It might not do that. It might just fall a bit from here. But if we're bearish, it's gonna decline. If we're bullish, it's gonna go up. Personally, I'm favoring higher prices, but it doesn't have to do that. It really doesn't have to. So I'm not going to be um, I'm not going to be trading Bitcoin that way. Ethereum same way, highs in November. Um, but these highs are more of a bearish seasonal for this one. Let's go ahead and look at what Ethereum is doing. This also, I think that this supports higher prices. So we can shop around in Ethereum. It's actually it's much more stable than Bitcoin, so it likes to chop around. The reason that this is much more stable is because I think it's Binance. They use it as a currency. They use it for a lot of transactions and everything that are I don't know. It's very important for Web3 transactions. So it's a little bit more stable. Uh, I think just because people are relying on I think just because people are relying on it as a currency, Jesus. Man, I really can't talk tonight. I really need to be taking public speaking or something, man. So let's go ahead and put that away. Again, nothing to write home about, nothing to worry about. We look at Solana. Now, why am I looking at Solana? I need to. I'm not reducing the period on this. If we reduce the period of the seasonals too much, then we're not going to get a very good read of what the highs and lows do. So yeah, for Solana, we're not even going to worry about this because we don't have a read. So we're going to ignore this one. We're not going to ignore this one when we get into the actual analysis of these charts. On the lower time frames, and the reason we're not going to ignore them is this one, Solana, is kind of the large cap. It's kind of the big player for. Actually, I got to do this because I removed all the. Excuse me. I removed all the drawings for to do this analysis. We're gonna put them back on as we work. But the reason that the reason that I selected Solana as one of the three quote unquote averages for the crypto asset class is because it's very big for game coins. Okay, so it's the largest cap, I think, game coin. Maybe Sandbox. What about Sandbox? Sandbox. Let me check. Let's see. Yeah, this one's no good. Solana is still the best. But like Bitcoin, Ethereum, and Solana, basically, I selected the biggest coins in their sectors. Let me see Monero. Yeah, XMR. This is always a fun one. Nice, nice. Let's see. See, I really like this one. I don't think it was bullish. I don't think it's anything. I just like the stability of this one. See how it just chops around. That's something you want out of a currency. You don't want it doing like these massive bull runs. You don't want to like just falling off a cliff doing anything crazy. You want to just kind of boom, 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 right in the middle. And um, the reason that you want that is so that the value of whatever's in your wallet stays stable. But that's the reason I like the Monero chart. Other than that, it's for trading, it's kind of garbage. Um, but we're gonna stay on Solana, Ethereum, and Bitcoin. Yeah, these three represent their own respective sectors in the crypto asset class. Normally, what you want is to have an average, right? To have an index, but we don't have that for this. We just have these, and obviously you can't just like compare and like average up and do every single coin because that's just completely impractical. You have to track the price movements of all the coins for that, and yeah, that's not something that we're interested in doing. Okay, so now bull markets for commodities. I do believe that most of the commodities, including the oil and all that stuff, um, right, the energies, which everyone's looking at them as if they're bearish, as if they're falling off a cliff, as if they're dying. I don't believe that's the case. Now, why? Let us take a look at their contract prices. So, normally, let's look at the normal one. Normally, with these contract prices, you're going to see that this is the near contract and this is the next contract. Do you see how these prices are higher? Um, or actually, the next, blah. Do you see how the next? Hmm, man, the words are all mixed up in my head right now. Do you see how the next contract month is a higher price than this current one? That is a carrying charge market. So now, why does this occur? Imagine, okay, so futures contracts for the most part, they are these contracts that entitle you to a commodity or some kind of an asset or, well, something, anything. In this case, it's bonds. We also have commodities. We also have currencies, all that stuff. But what it does is it entitles you to an underlying. Now, what happens with the underlying? Um, Somebody has to hold on to it, basically. So, like for example, if we go into with grains, for example, let's say that you're a farmer and you just have a ton of corn. Someone buys all your corn. but they buy it to be delivered in March. You have to hold on to that corn through, um, well, yeah, you have to hold on to the corn through March, right? So that means that you have to store it. You have to take on the risk that maybe that person doesn't want the corn anymore. You have to do all kinds of stuff. It's just there's extra risk, there's extra expenses. Some of the stuff is perishable. It has to be taken care of in certain ways. So it takes up space. Of course, that's another one. So as you look into the future, the price increases because whoever is holding on to this, um, the underlying, the underlying corn, right, the underlying soy and all this stuff, um, that person has to, well, that they have to keep the space. They have to keep the space conditioned properly. They have to worry about whether or not the person wants to buy the corn at the end of the contract. Basically, it's a bad time for the person holding on to the underlying, so they get compensated a little bit extra. Now, let's go back into energies. What do you notice about the crude oil prices? As we go further out, the price reduces, it goes lower. What does that mean? That means that instead of the carrying charge market, right, where the contract holder is charged for the person who has the underlying carrying the stuff, this is a premium market, which means that the current contract, it's at a premium, and then the next contract is at a premium compared to the last one, and then the last one is at a premium compared to the, you know, so it means that the first contract is a higher price than the next one, and really that's what a premium market is. So what does that indicate? What does that mean? Let's say that you're in charge of distributing the underlying. Now, what if you don't have enough? You're going to charge people who want your underlying immediately even more. You're going to charge them higher prices. Why? So that gives you a little bit more time to collect more of your underlying and fulfill the contract later. So basically, what you're doing is you're telling, through these prices, you're telling people that if you're willing to take delivery of this in March, you can get a better price. Why? Because that gives them time to collect more oil, right? So what that's telling us is that we have an oil shortage, right? So does it make sense for prices to drop during an oil shortage on oil? No, I don't think it does. And if we look at, well, if we look at all the other oil-based products here, we see that we have this same premium market, and we have one in gasoline. We have one in natural gas. What do we? Yes, we have one in natural gas. Now, I know that this one's the January contract where it really starts, but that doesn't really that actually indicates that a bull market is even more likely. But we won't go over that tonight. We'll just talk about this. Um, yeah, we'll talk about these premium markets. Okay, as a I don't know, that word escaped me. So basically, all of the oils, everything except for this one, including this one, ethanol. Wow. Okay. So all of the oil-based energies are at a premium. So that means we have a shortage in all of these. Basically, what that means when we go to where are you? There you are. We're just gonna look at crude. We're not gonna look at any of the others. Although there's interesting stuff going on there, we're not interested right now. Basically, what that shows me that is that these declines are fake. Okay. And when we start when we start analyzing the structure of this chart, we'll get into that. We'll show um we'll show what that looks like. Okay. Okay, so if we go into grains, we also see where are you? Where are you? Where are you? Okay, so we see that soy. Okay. Okay. Hmm. So wheat has a premium market. No, I'm sorry. Wheat has a carrying charge market. Very interesting. All of the wheat-based futures, they have a carrying charge market. So do oats. Do so does rice, and so does canola. Okay, so all of the soy, this is a premium market. So we have a soy shortage, a soy shortage. Soy shortage? Yeah, we have a soy shortage. Basically, is what this is showing. We go into livestock, we can see a lot of the same. So, although it's kind of surprising because not very much of these, well, not very much of these. A few of these are, yeah, what's the word? Yeah, a few of these have the premium markets, but I expected most of them to have one, which they're actually in pretty good shape. So lean hogs, yeah, lean hogs are good. Pork is good. Class 2 milk is all right. Mm, yeah, it's fine. So milk is fine. So butter. What's going on with butter? 64.95. No, this is cash settled. Whoa. Okay. So butter is very interesting. We'll leave it at that because we really don't care right now. Um, well, I care, but for the purpose of what we're doing right here, we don't care. Okay. So stop asking. We'll get to it. Just not tonight. Okay, so then we'll look here. Coffee, sugar, cocoa's trying. Let us take a closer look at cocoa. Yeah, cocoa's doing it. Okay, so we have all sorts of agricultural shortages confirmed. We're gonna have to look at this one because it's only one. Yeah, this one as well. Sugar. I forget which one sugar number 16 is, as opposed to number 11 and all that kinds of stuff. I don't know. It's nice though. So, um, wow. Ugh. Man, that gets me every time. That's just wow. Anyway, so now for something that's a little bit interesting. Um, if you look at the metals, we actually have a metal short. We actually have a metal shortage by the numbers for metals. So like gold, silver, platinum, palladium, and I think copper and aluminum as well. I think everything on here we have a shortage of. However, if you look at the futures contracts, you'll notice that we don't have a premium market. Now, why is this the case? Well, for the same reason that I didn't use the gold futures contract for our analysis, and that I'm not going to analyze the gold futures contract. I'm not going to trade it. I'm not going to touch it. Nothing. It doesn't exist to me. It's fake. It's not real. So the CME, how it settles gold contracts. Now, by the letter of the contract, you can, um, let's see, how much was it? Was this like a ton of gold, or was this, I don't know. I forget exactly how much gold it was, but you can, with, well, let's see. I think it says, I think it says how much gold you get. Hmm, where are you? All right. So you get 100 fine troy ounces of gold. You get 100 fine troy ounces of gold from a gold futures contract. Now, by the letter of the contract, by the law, by everything, you get that gold. However, the CME does not deliver that to you. Okay? The CME is supposed to deliver that to you. What they're going to do instead is they're going to give you a dollar amount equal to the value of that gold. The only people that they deliver the actual physical gold to is, I believe it's, um, is it Goldman Sachs? Do they give it to Goldman Sachs? I don't know. I know they give it to JP Morgan, but I'm not sure if it's just exclusive to them or it's just all the big banks that can get gold. But you and I, we can't get gold from a gold contract. What does that mean for man? What, what does that mean for gold futures? That means that we can't rely on them. They're not backed by gold. I'm sorry, they are not backed by gold. So gold, palladium, platinum, and I think you can get copper from them. Let me see. 25,000 pounds. That's not bad. It's not bad at all. Man, you better be able to get 25,000 pounds of copper from that. But the thing is, gold, silver, platinum, palladium. I don't know about the industrial metals. I suspect that it's the same. I haven't looked up. I haven't looked it up. I don't know. But the precious metals they don't deliver. So that they're not backed by their actual metal. So they're useless. Isn't that great? Isn't that the best thing you've ever heard today? Interestingly enough, the spot price is fine. If you buy gold spot, you can buy gold spot. But the the futures contracts, the reason that nobody's interested in them and nobody's running them up is because there's no gold there. They're not delivering gold. Same thing with silver. Same thing I suspect with copper. Same thing with platinum and palladium. I know for sure. Same thing I suspect with aluminum. Right? That there's no metal there. So of course they're not going to run those up. Nobody wants them. They're not in demand. Um, I don't know why they're kicking them up and down the markets. I think it's J.P. Morgan trying to move gold, or that's got to be banks because nobody else has any business with these. Nobody else has any business with these. They shouldn't be that liquid. Anyway, so that's the special thing about the metals. Takeaway here, you see these premium markets. Not in livestock, that's a bad example. Special example, but bad example. You see these premium markets, that means that there's bullish pressure in the market, just inherently. Okay? So these numbers going down as the list goes down, bullish pressure. If these are going up, that's fine. Um, but if those are going down, you're looking for reasons to bet up, right? So now it's time for the the real event, the event of the hour, our technical analysis. Okay. So now we've figured out with all of these assets, I have it written down from the weekend, what we figured out, what's gonna go on, what they're gonna do. So now it's time to mark up the charts and put limits on them, right? So let's go ahead and do that. We're going to start with the monthly. We're actually not going to go lower than the monthly. Now, why don't we go lower than the monthly? We're not going to go lower than the monthly. No, we're not going to go higher than the monthly. So the reason I don't want to go higher than the monthly is because it, those quarterly moves and those moves that are based on just just the higher um, the greater influence of the charts, they don't really matter. Um, Obviously they matter, but the structure of them doesn't really matter. It's gonna print. It doesn't matter what we do, what we mark up, what's well, they're just gonna print how they do. So first and foremost, we're gonna go ahead and use the PD arrays that ICT um, put out. Now he did um, 7 PD arrays, 7 basic PD arrays, and then he talked about more. I honestly don't believe the other ones exist. I think that they're permutations. I believe that they're different expressions of the basic 7 that he gives for um, price swings. So now, what do the PD arrays do? Well, they basically but overbought and oversold conditions into our charts, right? How do they do that? Well, I don't expect this high to get. I do not expect this high to get broken, right? So probably, if I find a feature along this price swing before this high gets broken, or before I can expect that this high gets broken, price is going to catch along there somewhere, right? So that at least that's how I conceptualize it in my mind. It's not That's not even a very good description of how I think about it, but whatever. I don't know. It's late and I can't talk. I'm not very articulate to begin with, and I don't know, man. Let's just start marking up the chart. So we're just gonna take this fair value gap. I don't care. There you go. We'll make it blue, and we will make it very low transparency. Now, here's something about the monthly chart. I don't like leaving these giant, huge ranges that the monthly chart comes up with. So if we find something smaller in the weekly, which probably a spoiler alert, we probably will. Oh dear. Do you want me to mark that? No, we're not demonstrating. We're marking a chart. So basically, we're gonna go down and we're gonna find different chart features that fit all the rules of the ICT PDs, and we're basically gonna mark these charts up. And then from there, we're gonna hit with fibs and do all that cool stuff. Market wizardry. So see, where's the fairy? Where does the FVG end? Here, right? What's the low of this? 105,906. High of this? 105,896. So it's inside it. Know what that means, right? That means that's an order block. And we're gonna paint it yellow. Now for the order block wick, that can also be a breaker. So we're gonna paint this one red. I like red for my breakers. See that? Isn't that pretty? Isn't that beautiful? So this is the kind of stuff that ICT was talking about. He was saying that these PDs, this price structure on these very low time frames, it doesn't matter that much. But the analysis from the higher time frames, the intermarket, all this cool man, everything. It's much better. It, I'm sorry, it makes the PDs work, right? So you see that? Okay, so now we've marked up the chart, more or less. No, let's take this as well. Yep, this right here. We're gonna make this purple. We're gonna put this at 20%. Do I like the warmer purple? Yeah, that's kind of nice, isn't it? No, it's terrible. This one's better. Okay, so um, why did I mark it like that? Well, because we have CPI, and we're gonna go over CPI in. We're gonna go over it when we go over how we expect a week to develop, right? Already, it's doing some kind of cool stuff. Trying to think, is there anything else? Nah, not for right now. Right now, right? No, we're gonna look at that in a second. Let's close that. We're gonna need that for the daily range and the weekly range. But for now, it kind of sucks. See this? That's all right. It's not terrible. Mm, let's see if it means it. This is just out of curiosity, by the way. This is not like um, yeah, it can reach there for CPI. It can do that. It can definitely do that. It can also not quite do that. CPI is a wild animal. You can also look at this kind of. That that also works a little bit. Mm, I don't know. We'll figure it out when we'll white glove that in a minute. Let's go to our bonds. Well, we'll do Bitcoin last. I know everyone wants to see that one. So we know bonds up, right? And we know them up from like right here, basically. Not the 1 hour, the weekly. Okay. I am intrigued that it may. So we'll do that. 5%. Daily. Okay. So the daily is right there. It's already marked. So I expect it to dig into here for CPI. Right? Does that make sense? What does it make sense that it's going to dig into this area for CPI? Because it might not. It might also just run higher. I don't know. Don't know for sure. So for here, this one already did it. And let's move to the daily, see what's up. It's not much of anything. Let me see this one on the daily again. If we follow the rules, there's this. That kind of sucks though. Yeah, this one kind of sucks, but we're gonna mark it anyway. I'm gonna call that the order block. And there's also this. Is this Wednesday, then Thursday? Yeah, that is. So that's not a new week opening gap. It's on the daily chart though. And it's inside the order block. So we can reach into that for CPI. That's possible. I don't believe it's likely at all. But maybe here. Maybe into that order block. Let's see what else. Yeah, I don't see very much else in this chart. I mean, there's also this stuff to this, man. If we get down here, we're really in trouble. We're really bearish in the bonds if they're trying to reach down after all this, after all they've done. That's just nuts. That would be wrong. So here we have this cool stuff. We're gonna go down to 5%. Please, opacity. There we go. Thank you. I'm gonna go down to the daily. Take a look. Take a look. Mm, really? This one? Okay. All right, if they really insisted. Oh, that's why. Okay. Yeah, that makes sense. That's fine. So the 5 year and the 10 year, they can shoot off by themselves. And that's actually completely permissible. That's perfectly fine. The reason it is because the yield curve is inverted. So what that means is that the normally what you get is you get the 30 year on top of the 10 year and the 10 year on top of the 2 year. Right now what we have is the 2 year on top of the 10 year and then 10 year on top of the 30 year. So that's kind of a deflationary idea. That's something that yeah, it's a really weird mechanic. It's a really weird dynamic. So, but what that means is that the 2 year and the 10 year are a little bit lighter than the 30 year. So the 30 year can dig down. It can do all kinds of crazy bearish maneuvers that the 10 year and the 2 year won't even imagine doing. But the 30 year will have no problems doing it, which is what we're on right now. The T-bond futures is 30 year. So so yeah. All right. Moving on. What do we have next? We have indices, right? Let's go. So, where are you? Where are you? All right. I'm going to use the contract months. I use the continuous contracts for the seasonals just because the continuous contracts contain all of the data forever, basically. Um, these these monthly contracts, they kind of die out because look, that's the very end of it. Nothing. There's nothing more past 2022. But but yeah, we could really be cooking with this one, um, the December, because it's a lot more accurate. So now something that I noticed when I looked at the seasonals. Hold up, let me pull this up. Let me get this real quick. Try to illustrate this. Continuous contract, one day. There we go. All right, so see how it just kind of charges up, charges up, charges up, then retraces, charges up, charges up, charges up, right? What that does for me on this daily chart is that it kind of eliminates the expectation that this is going to retrace a ton. Um, this is not, well, I don't believe that this is going to come back to this fair value gap. If it does, I don't think it's taking out this low, and it's just it's not doing it. It doesn't have the juice. So what I'm gonna do, I'm gonna highlight this from here to here, and I'm gonna use the daily chart and the wick. There we go. It's gonna be red just because it's a wick. So I'm gonna use the daily chart to highlight my discounts because I expect the daily and the 4 hour and really the 1 hour at the very end of it. Well, not just at the very end of it. There are going to be some times when the 1 hour is going to be expected to support price, but I really expect the daily and the 4 hour to do most of the work. The weekly, don't care so much about it at this point in time. Um, for targeting, yes, but um, for kicking off this move, I think we've already interfaced with the weekly as much as we're gonna want to. So so yeah, we're gonna use the daily and the 4 hour to, yeah, look at that wick. Look what it's doing to that wick. That's crazy, right? Isn't it? Isn't that crazy? That's crazy. How should I highlight this in the 4 hour? Because these are going to get smashed out 100%. These are getting smashed out tomorrow. And into this. Is that good enough? Is that annotation fine enough? Does that make enough sense? We can come down. Is that right? No. What did ICT say? The highest down close? Okay. And he also said something about order blocks being the halfway point being sensitive. Right? Because once the halfway point is crossed, it should no longer be crossed. It should not be crossed a second time. So we can take this. Okay. So I'll take this. I'm happy with that. And I'll take what else should we take in this? Because we do have this premium right here. We can use this. Let's use this. Blue. There we go. We're going to bring that down to 10% so it's not overwhelming, so we can annotate during the day. Okay. All right. So that's my CPR chart. That's what I'm ready to do. So what CPI is going to do that I think, well, what I think CPI is going to do is I think it's going to punch out these lows and come down kind of around here-ish. Once it's done diddling around here, it's going to be off to the races. It's going to be bullish through the rest of the week, by the way. But I'll tell you what, we ain't got no order block. We have this right here. And that's it. So let's do that. Let us have this be our order block. There we go. Perfect, beautiful, right? Isn't that nice? Doesn't that look nice? So now we have the lower limit of CPI. Where's it gonna go? I have no idea. Right? Under here somewhere. It can go here. It can go here. I think that it's highly, extremely, extraordinarily unlikely that it's gonna go much lower than this. But it can go here. Right? So watch for it to go here, basically. But once it goes under here, once time is up, it should be fine. There shouldn't be any more problems. It should just be bullish from there. So let's go NASDAQ. Let's take a look at NASDAQ. It is weekly. Neat, awesome, very cool. Daily. Actually, is it? Let me see that weekly again. Interesting. Okay. So it has this right here. This can be a discount. We go to the daily. We see this. Abomination. Oh no. No, 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 no. We don't want that. let's let's not have that. Let's not be doing that. That's not right. That's just not right. So this of course 5%. It's on a daily. Oh, I expect that wick to take price here. I don't expect price to get much further than that. So even though on the daily chart, no, not this one, the yellow. There we go. There you go. That's your order block color. Makes you feel much nicer. Anyway, I don't expect price to get down here. I really don't. And once again, the reason is because we're reaching higher. And once, oh shit. Shoot, 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 shoot. Let's see. Yeah, so this did the work that I would expect, that I would blah. This did the work that I would expect CPI to do if it were to take out lows. Um, it's going to take these ones out, of course. These ones are dead. These ones are done. They're not printing. But these ones are safe. It's fine. Where are you? We have this. Come on. Here. That's fun. I want to sleep. Mm. Excuse me. So yeah, don't want to go under an hour. We'll be fine. It's gonna come under here. I'm gonna go in the YM. Where daily, weekly, daily. Probably this. Purple. And then there's the wick. Here I'm not even gonna mark the wick because we already have the purple in there. But we will mark the order block. Come on. No, you're not purple, you're yellow. There you go. There you go, buddy. Here we are. Oh. So this is Wednesday and Thursday. Is that still applicable? Let's see. Let's go to the front. Highest. Alright, I'm sorry. Largest down candle within the bounds. Okay. No, it's not within the bounds. Never mind. This one. And then for the targeting, we're gonna use some uh, should I use these? The ICT said specifically you didn't want people pirating. That's kind of how I learned this one. Okay. So this 4 hour Dow can actually be the lightest one of these. Whatever, we're not trading it. We're just monitoring with Dow. Um, ooh, what else? Did I miss something? Did I miss one? I know I missed you. No. Hmm. So I know I looked at the Russell to begin with, but we're not trading it, so it doesn't matter. All right. So targeting. Let me go to the bathroom real quick. I'll be right back, and we will do targeting. Okay, so the upper boundaries, the upper expectations for these equities. Now, how can we build our expectation of what they're going to do? Do, where are you? We're on the 4 hour. Okay. No, we're going to drop down to the 4 hour to figure out what we're doing. So we're going to go ahead and go on the, I guess, the weekly, even the monthly. And we're going to start drawing projections. So what I'm looking for is I'm looking for consolidations to kind of correspond with these lines. I am looking for consolidations to kind of correspond with these lines. Now, when the market is reaching for a certain objective, what it's gonna do is it's gonna consolidate at like, well, it might consolidate at this first quarter. It usually always consolidates at the second quarter. The third quarter, it's not very likely, but it's notable that it might be able to consolidate. And then it consolidates up here at the terminus usually, and then it repeats the process all over again. The the thing, where is this? Yeah, that's fine. So this is a phenomenon that you're really gonna see in a I guess a macro sense. Oh, where? Let's do it. Let's do it this way, because this gets us our quarters too. But so basically, where you're gonna see it can be here maybe. Yeah, yeah. You're gonna see kind of a ABCD projection. Yeah, and it's gonna get where it's going, right? Isn't that cool? Above this high. There we go. So we're gonna target this high. This one right here. It says green. We're gonna say it's solid. We're gonna take this one as well. Okay, so what was I talking about? Well, the market usually when it's moving to a place on a large scale, it likes to move and then it likes to rest and then it likes to move and then it likes to rest. Okay, so when ICT talks about it, he calls it a buy model and a sell model. Um, I'm trying to think if maybe I'm confusing that with something else because I know that the buy model and the sell model they're two sides of a manipulation, or they're kind of a consolidation type behavior. Um, well, yeah, it's basically a consolidation type behavior, but this is a very similar concept that he also came up with, where you're going to see these consolidations form at sort of these quarter levels. Quarters. So is that quarters theory? I don't know what quarters theory is. But basically, when you have a giant, um, I guess a short, intermediate, and long term trend on a high time frame, it's going to end up manifesting as with blah. It's going to end up manifesting with these impulses that create these consolidations and then impulse to the next level, create these consolidations. So it's what's the word? Uh, so it creates these levels in a trending move. So right now we can see that the second one has created consolidation, and now it's shooting off to take these highs, right? So that this whole thing is the reason that I don't expect price to come down under here is because we've already tested this, we've already done that, right? We've been there, done that, and now it's time to shoot off to these highs, right? So that's my expectation. That's what I think is going to happen this next week. Let's go ahead and look at the S&P because if I remember right, that was the one. Do it. There you go. So if we go on the weekly, we can start marking this up. Yep, it's good. I think this is the one, but I'll take the whole thing. Don't mind if I do. I think we should take this high. And I believe if we go on the daily, yeah, we're gonna take this one. All right. And then there's also a couple of other things that um, I do in my own analysis, like commandments to traders, straight from ICT. I know it's a shameless rip, and also I check the news, I check MSN, I check that state sponsored stuff. So I get an idea of what people are supposed to think. Um, so yeah, should we get stupid? Should we peg the high right now? Do I care enough to peg the high? No. I'll peg the high as we get closer. But for now, there is really no need. Undo. Thank you very much. We can also dig up. No. We're doing this week. That's what we're doing. Undo. This is the daily, right? Yeah. Do it. There we go. Okay. So the NASDAQ, I expect it to outperform everyone else. Um, it also doesn't need to reach all the way up here. But I expect this high to get taken out. We go on the weekly, let's look at it. Yeah, alright, so let's put this just for our own ego's sake. So that way we could say that we called the high getting taken, and these two, they can get taken or not. We don't care. This is also an order block, but that's not part of targeting. So yeah, the only other ways that we can target peg higher highs than this one. Same monthly. Oh, that's right. That's the bad one. But yeah, we can take this high, no problem, and that's fine. Once we take this high, uh, the the monthly Nasdaq chart is going to be at the end of its rope, but this is fine. This shows us that we have price structure behind us. We can take this out, no problem at all. Doesn't even matter. Doesn't change a thing. So probably this high gets taken. Let's see the YM. That's the one that we didn't do yet, right? Yeah. And then of course, let's go NQ one more time. Should I mark that like an ICT high, or Or does it matter? How far does it say? What's the projection? The high itself? Okay. 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 All right. Yeah, let's play. Let's play. Was it 624? Okay. So I think it's 640. What was it? 200 points above the high? What was the stop run on the long term stop runs? Hmm. I don't know. I forget the big ones. I know that's like 10 pips, which is I think it's like 100 points in Nasdaq. But that was for just the little liquidity runs. This one's a big one. So that's why I'm sweating it right now. That's why I don't know what's, yeah, right there. That's fine. That works. What color should this be? Some kind of I don't know. We'll do it white. There we go. Zero, please. Oh my god, please be right. Okay, that's perfect. Whew. Okay, all right. So yeah, I expect to get up here. This is the PD that I expected to hit. Do undo this, please. Come on. Thank you. Oh my gosh. I'm gonna go into the weekly. Cause hmm, this is gonna be a speed bump eventually. This is gonna be a speed bump, and this is gonna be a speed bump. You know what? These highs are fine. Those highs are plenty. We don't need anything more than what we have on this chart right now. Everything else is perfect. Perfectly fine. We go on the YM. We're gonna see what it hits, what it wants, what it needs. There to there. It needs those. Okay. That should be fine, right? I'll do that YOLO, I guess. Do it on the weekly. That's fine, right? That's good. And we're gonna go on the 4 hour. Take a look. That's fine. All right. Last one is Dixie targeting. So I'm guessing. Man, I don't know. I don't want to target with Dixie. I really don't. Um, I don't think that it's running. So I'm going to assume that it's not doing that. Mm, yeah, all right. So Dixie, we're just going to play by ear. We're not going to. Um, we're not really going to target with that. And and most of the reason that I'm saying that is because I'm tired and I don't feel like figuring this one out. I didn't give this one a target when, hold up. Yeah, I did not give this one a target when I was doing this for myself. So that's another thing. Uh, that's conservative. That's fine, right? Yeah. There you go. There you go. Dixie target right there. There you go. So of course I expected to just kind of rip right through this, no problems at all. But I don't know, man. That's just kind of a target for you. Let's go into crypto. Yeah, finally, crypto. Yes. All right. So crypto, I have the same expectations as the S&P. So why? Why do I expect crypto to do the same things? Come on. There you go. There you go. Because because with crypto, let's turn this red. If if we have a bull market, it's just gonna charge up. It's not gonna stop. It's not gonna pass go. It's not gonna do anything. It's just gonna go straight up. If we have a bear market, it's just gonna go straight down. So if we lose these levels, I don't even think that it's gonna get to this order block, but I'll mark it out just to be rigorous, right? If we lose these levels all the way down to this order block, we're not going to have a bull market. I'm sorry, but that's just not something that we're gonna have. As far as upper projections, this one's a real bull. Blah. As far as upper projections, this one is a real bull market. So it's just gonna go straight up. It's not gonna do anything wrong. I don't know. It's just gonna go straight up. See, is there any refinement I can do on the 4 hour? Is there any refinement that's worth doing on the 4 hours? Better question, because I can see tons of refinement I can do. I just don't care. I really don't care because it's so late. Uh, fine. We'll refine like that. There you go. There you go. There you go. Your 4 hours are fine. We also have this. Do we have this? Yes, we do. Boom, refined. There you go. That's perfect. So we're gonna look at Ethereum. Ethereum's looking fine. Now the question is, why haven't I broken out the fib? Why haven't I broken these down into four quadrants? And it's because I honestly don't care. That's a level of refinement that's it's okay, but you can just look at this and you can see that yes, this is an order block, and yes, we're probably coming down under this wick, and then we're gonna shoot off after CPI. So man, is that even worth anything? Is it even worth anything to put? We can put it in here, I guess. Yeah, there you go. CPI low right there. There you go. There you go. CPI low. Oh. Hey, come on. There. There's your CPI low. And we're going to do Solana as well. Look at the daily. And once again, um, we're not particularly interested in looking below the 1 hour. I'm sorry, the 1 day. Um, and the reason that we don't want to look below the 1 day is because it really doesn't matter. This is fine. It can come down here for CPI, not much lower. Let's do the yellow. That's fine. Oh man. And I'm tired. So if I look on, yeah, that's just about all the markets. All right. So now let's talk about the weekly profile. So we expect a bullish market in most of these markets, and in fact, all the markets that I'm planning on giving my attention to during the next few. Oh, I didn't look at gold. That's right. I need to look at gold. Yeah. No, this one. There you go. So I need to look at gold. Let's go on the daily, weekly. All right. There, this one. That thing is massive. Ooh. Here, this one. It's coming. It's going here. It's going here. Actually, gold might go there, and it might not. Let me see the daily ranges. Is that reasonable? I don't think so. So yeah, that's a daily range. And that's possible in a daily range, but only from this low. Yeah, so I don't think that is going there. I think it's digging into here, taking this low out one more time, and then rocketing off. That's what I think of gold. It might hit that wick. It might take the wick. Blah. It might take the wick. I really don't know. It might not even do anything. It might just rocket off where it is. This is probably going to rocket off where it is. All right, so let's talk about the week. How do we expect the week to blow over? Well, let us go on the 4 hour chart and let us activate our weekly profiles. So, what you'll notice about these weekly profiles is um, when the market is bullish, it dips under the weekly open, And when it's bearish, it goes over the weekly open, right? When does it dip under the weekly open? Well, for the most part, the most blah, anytime it can really dip under the weekly open. But for the most part, when news prints a dip below the weekly open, then um, the low that the news prints is safe. Okay, so we can see here as well. This one's dirty. That's hard to see, right? But you can see that it printed. It came up, printed. It really didn't print below the weekly open. It did. It did a little bit right away, and then it went up. Here it went down. Prints, drops down. Whoop-de-doo. Goes up and drops down, right? Goes down, drop, blah. Goes down, runs up. Reverses, right? That's some cool action, right? Comes up, drops down, reverses. So, how do these weekly profiles happen? Well, for the most part, the most reliable turns in the market, they happen in relation to some kind of news, okay? So a medium or a high impact central bank release, or a medium or high impact economic release of some kind is going to print a low or a high into the market basically, and either that low or that high, it's going to interface with an existing one. And in this case, we can see that happen. That can actually happen here, or the other thing that can happen is that it can print the low or the high itself. In either case, wow, that was a mouthful. Um, Allow me to rephrase that. So on news, the expectation that you should have is that it's just going to sweep out the lows of the market. It's going to rip out the bottom. Um, and then once it reverses from that, the low that it creates is going to be safe. What that expectation is going to give you is that anytime that the market comes down on news, you're going to be anticipating the reversal, and when the reversal happens, you're basically going to be in it, and you're going to have a pretty decent part of the weekly range. You're going to have most of the weekly range behind you, um, both with probabilities and with the gains wise. I don't know. It's late. It's late. Um, I should not. Well, I should not be explaining these things at this time of night. At least not with some kind of rest. Basically, your base assumption, since we're bullish, is that Monday or Tuesday it's going to print the low, and then Wednesday and Thursday is going to print the bulk of the range, and Thursday or Friday is going to print the reversal. So what we want to see is we want to see in the economic calendar reasons for it to print the range in a certain way. This is going to refine our ideas. This is going to help us figure out if we want to be looking at Monday, Tuesday. Well, I'm sorry. This is going to help us figure out if we want to be looking at Tuesday, or maybe if we have a solidified range already. Maybe if we, I don't know. If we're going to be left holding it back, feeling stupid, which is always a possibility, even with this. But as we can see, tomorrow we have CPI. Um, So at CPI time or at RTH open, I expect the market to reach down and take out these lows. Is that a reasonable expectation? Well, that's moderately reasonable because this is already printed a low like this. We might not actually see a lower low. We might just see this kind of left in place. So basically expect tomorrow to print the lower low, but don't like count on it. If it doesn't want to do that, don't worry about it. Um, just that second low that gets printed is safe. Um, what else? After that, we don't really have a whole lot. We have all this. Well, we have PPI, which is more inflation numbers. We have retail sales, uh, unemployment, retail sales, all that kind of stuff, cool stuff. Going through Friday. Um, this could cap the range. I don't know, man. But basically, our eyes are going to be on the CPI numbers. We don't really care what the numbers are. We're already aware that they're a lot worse than the Fed is telling us, and then the Treasury is telling us, then all the banks are telling us. Then it's very bad. Um, whatever number they come up with, it doesn't matter at this point. At this point, it's just kind of a number, you know. But what they do with the market when the number hits, um, yeah, what they do with the market once the number hits, that's what matters. And it can either come down here or it can come down lower. If it doesn't come down at all, that will make me suspicious. I will start exploring bearish options. Um, but it can come down here. Basically, we want to see it displace lower, um, and then displace higher. Do the ICT juju swing. Yeah, here with the Dow, it can come down here. Or it can break this order block and come all the way down here. Well, it can break this order block and come all the way down to the original one as well. Let's see Dixie. It's going to have to come up. So it's going to come up into this order block right here. Yeah. Or this one. It might reach all the way up here. I don't know. But we're going to start looking at it here. Did I miss anything? I missed the bonds. I did miss the bonds. All right. So the bonds as well, they can do the same thing. They can drop down. Either all the way down or just kind of there a little bit. I do expect the the ZB to take its lows, but the other ones don't have to. They really don't. To, as far as their highs, oh, I don't care what their highs are. Let's see. Did I miss anything? I don't think I did. All right. So that was probably very confusing, probably very hard to follow. Um, Honestly, it was very hard for me to follow as well. Even just even though I'm doing it, I'm the one who came up with the actual uh, process, and it was even hard for me to follow. So yeah, that's what happens when you're talking and you're not used to it. So in conclusion, we're just gonna do a quick summary. So on the macro perspective, which we analyzed everything on the quarterlies. Hmm. On the macro perspective, we analyzed everything on the quarterly charts. Um, we used the bonds, and we measured the bonds against Dixie. We measured the bonds against the indices in the commodities, and we measured the bonds against the equities indices. Now, for measuring the bonds against the Dixies, we look for a direct correlation on the quarterly chart. Measuring them against the commodities, we were looking for an inverse correlation. If we didn't find an inverse correlation, we assumed one. Okay, we assumed that one was going to emerge. So then we looked at the bonds, looked at the equities. We looked for a direct correlation. We didn't find one, so we assume a reversal is going to happen in equities, right? So then what we did is we went to our intermediate term. Well, it was our long term and our intermediate term rate, and we checked all of our assets for their seasonals. Okay, we looked for highs and lows on a fast and a slow. Boom. We used a fast and a slow seasonality chart. I'm sorry. We used a fast and a slow seasonality measure, and we identified let's go on the daily, and we identified highs and lows that occur in the marketplace, just kind of normally, right? We found constants, right? We found constant trends, we found constant highs and lows, and we scrutinized those. We analyzed those for divergences from the norm. Um, and then we started comparing the assets with each other, okay? So we compared the very closely related assets ones, like all the bonds, the 30, the 10, and the 5. Um, and we also compared them to the Dixie to see if there were any divergences. We found divergence in the Dixie, which confirmed that we were going to get lower prices in the Dixie. Um, so through that, and through confluences with the seasonals, we found out that the equities are moving up. We found out that the T-notes are moving up. And we found out that Dixie was most definitely trying to move down, right? At the same time, based on the seasonals and based on the macro perspective, we found out that the uh, and it's a metal and it's on the edge of my tongue and it's the most common metal too. This is embarrassing. We found out that gold was going to be moving up. Okay, but because of fundamentals, because the world is standing still right now, um, we don't really expect much higher prices in gold. We expect them in equities. We expect a mad dash up in equities, but we don't expect very much about gold. We just expect it to move up a little bit. Um, let's see what else. Was that everything? Well, then we analyzed price structure and using what we had learned from the seasonals and from the macro perspective, and really from our intermarket, we analyzed the price structure of each asset, and we found out where the most likely place is that they're going to reach for, and um, well, yeah, the most likely places that they're going to reach for, and then we use the economic calendar to tell us when we expect the market to reach for them. Now, if the market has already reached for them, um, we don't really demand that the economic calendar create that movement. Um, Usually, we do demand that if the market has not reached for it, um, the objective that we identify, but we don't really demand that if it's already been hit. Then there's other things. Were there other things? Yes. So in grains and in commodities, we looked at the yeah, and in energies as well. Um, I know, primarily in energies, but in the energies, in the grains, in the livestock, and in the softs, we identified premium markets, which are markets that are predisposed to be bullish just based on their fundamentals because they have no supply. Right? The demand exceeds their supply, so they're printing premium markets in their contract months. So we identified different markets that are like that, and with those different markets that are like that, we expect lower prices to get cut short, and we expect higher prices to just be crazy, parabolic, right? Is that it? No, we did one more thing. We looked at the metals and we explained why the metals are fake. Why we don't want to be relying on metals futures, why we don't want to be in metals futures, why do we don't want to be interested in reading metals futures, and why only the spot price is important. And the reason that we don't want anything to do with these is because they're fake. They're not deliverable, right? They don't represent the actual metal. They only represent the price of the metal, which is debatable because they don't. Um, you don't really get the price of the metal out of it. You get the price of the futures contract that you pay for. Does that make sense? Because it doesn't make sense to me, right? So that's why I don't want us touching it, right? Did I miss anything? All right, so this is probably very confusing, but I will be doing this every week. Um, Literally top down, top down. we'll be starting with clean charts every week. Start with the 3 month chart and work our way down. Figure out our daily bias. It's gonna be faster every time. It's gonna be better every time. I'm gonna be better at presenting my ideas every time. It's gonna be a lot less confusing every time. Until then, basically, just our takeaway is that um, my piece of paper that tells me my notes is true. Dixie is going to be lower, bonds are going to be higher, equities are going to be higher, gold is going to be higher. Crypto, we expect higher. We're going to monitor it. We're going to monitor it. Um, if crypto doesn't just go parabolically up, if it breaks structure to the downside, even a short-term structure, we're not interested because it's going lower. Um, so that's about it. That's about all I have for you. One more thing, currencies, I wouldn't be in them. I wouldn't be interested. Um, the reason is because Dixie is kind of being kind of screwy. You know, it's a little bit hard to predict right now. So if Dixie is hard to predict, the other currencies are going to be hard to predict. So I would say stay out of forex, stay out of currencies, stay out of all that stuff. Don't play with it. Just mm, just stay in currency. Well, I'm sorry. Just stay in things like bonds and equities and crypto, and we'll be fine. All right. Anyway, that's all I have for you. Um, I'll see you next week or throughout the week. You see me on Twitch. Anyway, good night.